Welcome to the Money Mentors Podcast.
Welcome to Money Mentors. I am Gerald Green here with Corey Davis, and I'm seeing signs of spring, Jennifer.
Oh, really? No. What are your signs of spring? Because I'm not seeing them yet.
The only sign, it's the unofficial sign of spring. It's pitchers and catchers report. So,
yay.
And then my team decided to go out there on the first spring training game and lose 20-3. So,
well, you had a moment there. But 20-3. Oh boy.
Yeah, when you run your younger guys out there, I'm pretty sure the Yankees started their opening day lineup against our single A ball club.
That's true. There's time. There's time to get better at this. But how about last weekend, guys? I know, Gerald, you're a huge hockey fan. Corey, I think everyone was a hockey fan last weekend. So did you catch that game?
I was up at 7:00, right, pre-gaming already.
Knew it.
So
I knew it.
Hey, we can talk about hockey for an hour if you'd like.
Maybe Money Mentors today is the all hockey show. I don't know, but how cool to see the U.S. men's hockey team come home with the gold after that thrilling win over Canada in Italy. But it's interesting, guys. I think there might be a retirement lesson in this, because as thrilling as that final goal was for the U.S., it's actually defense that really helped them win that game. What's the goalie's name, Gerald?
Connor Hellebuck.
Thank you. I keep forgetting the last name. I really need to ingrain that in my head, though, because he was just amazing. So really, though, a good lesson for investors, too, because, if you think about how we go through our investing and saving lives, sometimes it's not the big risky shot or investment that wins the game. It's actually the defense on your investment strategy, isn't it?
Yeah, what you have to do is, and it's funny because I had this conversation with my brother after the game, who's doesn't have the hockey knowledge that I do. He played football and basketball, so I was kind of explaining to him. He's like, why is it that, when Canada had the puck, they were always looking like pressing and getting all these shots, but when we had the puck, it'd be like one shot and done. Well, it's the type of defense we had to play against that Canada team. You couldn't press Canada because of the skill level they have. So what you try to do is you clog up the middle so you don't have those cross-ice passes for those bang-bang shots. So I went a little more involved in that, but if you get me down that rabbit hole, this will turn into a hockey.
I'm interested. This is fun. I didn't know about this.
But yeah, that spoke directly to it. It's playing that defensive strategy, knowing what your skill level is, what you're comfortable doing, and what you're good at doing, and then being excellent at that. Look for your opportunities, and when those opportunities are there, that's when you make the play. That's when you make the extra pass. That's when you shoot the puck. And it always helps when you've got that safety net in goal. Let's say that, it doesn't matter what happens. It's unmovable. It's an immovable object. Nothing's getting by it.
Part of that defensive strategy I think a lot of investors are talking about right now is gold. Not so much gold medals, but let's talk actual gold here this week, guys. Those prices have continued to soar through the first part of this year, and I'm sure you're getting a lot of questions about this too. So what's your take on gold as part of that defensive strategy in someone's portfolio right now?
Sure. So gold is always a defensive strategy to use in a retirement portfolio. But what I've been warning clients about lately is once you hear it in the news and how it's taken off and done so well, it's probably too late. You definitely don't want to go all in on something that you're hearing is at all-time highs.
Right.
That's kind of the opposite of that buy low, sell high philosophy. You don't want to trade on headlines or base your plan on things you're hearing in the news, because at that point it's most likely too late, and it's probably not going to shoot up again as much as it has over the last year or so.
Yeah, when you look at it, having a diversified strategy before things start getting into the news, that's how you know you have the right type of plan, right? It's a matter of being diversified. You don't know what's going to happen or when. The markets nowadays are extremely volatile. So it's not a matter of trying to predict when you should get in, when you should get out. It's a matter of having positions that are within your portfolio to adapt. So gold is a great hedge against inflation. And when I look at some of my clients who have been in gold portfolios that I have them in because it was suitable for them, They're like, why didn't we put all our money in gold and get rid of that Microsoft and that NVIDIA stuff? It outperformed the S&P 500 for the last year. So, and he said it kind of tongue in cheek, but it's about being diversified and having options. So whereas the S&P 500, for instance, over the last 6 months has been kind of sideways. Mm-hmm. You'll have a couple, we're up 1.5% today and then down 2% the next day. So the market as a whole since roughly November has been trading sideways. Having a diversified portfolio gives you the opportunity to get growth from another investment strategy, and you don't have to react to all that stuff that's in the news. You don't have to try and predict where you should go with your money. You've already got those positions there. Having the diversification and also having other buckets to be able to pull income from, those safe buckets.
I'm glad you mentioned this, kind of that sideways market here, Gerald, because a lot of people might feel stuck at a time like this, even though you're hearing the headlines about, market highs and everything. You're right. We're kind of in that same trading range, right? We went up to 50,000 with the Dow. We came back down just a little bit again. So again, we're kind of in that range. How do you still look for opportunities when the market's kind of in that narrow range?
Well, it comes down to what Gerald was talking about, having the diversified portfolio so that there's more to look at than just the markets. There are different types of investments out there that aren't always going to be going up or down when stocks and bonds are going up or down. There's income generating investments. There's all kinds of things that you need to look at when it comes to that retirement plan instead of just looking for that next opportunity in the market to get in or get out.
Yeah, when you're looking at your growth strategy, and when we say growth, we're thinking stocks, some of those more volatile positions. There's aggressive growth, and there's stocks that are considered defensive stocks, where they may not get into the headlines every now and then, and they're not going to have NVIDIA type earnings of, 51 cents per share on the dollar or whatever that is, right? Mm-hmm. But what they do is when the market's trading sideways like this, you can focus in on a dividend paying strategy. So you're going to own these stocks, and the market may trade sideways, but because they're such good dividends, you're still making money in your account for just owning that stock. So even in a sideways market, there's opportunity. It just has to fit for what your dreams, your goals, and your desires are.
Again, sometimes it's not about the flashy thing. It's not necessarily the NVIDIA or the gold that's going to get you to your retirement goals. It really is building that kind of portfolio that sustains you all the way through retirement, gets you the kinds of gains and opportunities that you need to achieve your own income goals. But for our listeners today, we want to give them that chance to come in and do that deep dive on their portfolio, because I think sometimes we do get fixated on the things that are making headlines, not necessarily the things that are going to get us to where we want to go. So for a few of our listeners today, why don't we open up that invitation, guys?
Yeah, if you're listening to us today and you've saved at least $250,000 or more for retirement, give us a call at 1-800-536-8907. We've got people standing by to take your phone call right now, live in person, and sit down with myself, with Corey, Gary, Taylor, any number of our advisors, and let's talk about what your current situation is today, what you're looking to do, what your goals are, and set up that comprehensive plan that's going to focus on not only growth strategies, but income strategies and taxes, estate planning. We want to build that complete plan that's not only going to get you to retirement, but get you through it.
You can talk to one of our great team members off the air at any point during today's show, right here in West Michigan at Mattson Financial Services at 800-536-8907. And Corey, I would imagine when you're doing that second opinion for someone who comes in with their portfolio, I would imagine you find some little opportunities there, or maybe help them discover that they might be taking too much risk with a particular investment. I would imagine those first visits are kind of enlightening for some people.
Absolutely. That's what's important when you're first sitting down for that second opinion, is really analyzing what you're doing now. It's not just about the plan going forward, but what's currently happening, and that opens up that door to know exactly where you need to go moving forward. So analyzing the fees, analyzing the risk, analyzing your estate plan, all those things together as part of that overall plan.
And again, we're doing that complimentary for our first 5 callers today here on Money Mentors. So take advantage of that offer with us. In fact, you can pick up the phone during the break here. Talk to one of our great team members now at 800-536-8907. They're going to give you a list of helpful things to bring on that first visit, some statements, the things you might want to go over with some of your questions with your Money Mentors. But it's all complimentary for you to get started today. So if you have those questions for us, reach out again, 800-536-8907. Or you can find out more about our investment philosophy, how they do things differently at Mattson Financial Services, right on our website at mattsonfinancial.com. In fact, you can schedule a 15-minute phone call there. That's Mattson with 2 T's. Financial.com. But coming up next, how valuable is that 401k deduction at tax time? We're going to have a different take on that coming up for you next as Money Mentors continues right here on Wood Radio.
Want weekly lessons from your money mentors? Yes. Hit the subscribe button now and listen every weekend on Wood Radio.
Every day is like a weekend in retirement. That's why we're here every week with your Money Mentors. This week, it's Corey Davis, Gerald Green from the team here. And as always, if you have some questions for us about, making those retirement dreams, goals, and desires a reality, reach out to us today with those questions. Share that list with us at mattsonfinancial.com. Or you can always talk to our team off the air too at 800-536-8907. And I had to get us in a good mood here because our next subject today is one that a lot of us are familiar with this time of year, taxes. And one of the things that you might be talking to your tax preparer about this time of year is how much you contributed to your 401k or your IRA last year in order to get a deduction. Well, retirement tax expert Ed Slott actually has a beef with this kind of deduction terminology. Listen to this.
That's not a real deduction. I don't even know why people call a 401k contribution a deduction. Yes, it reduces your W-2 income, so it's, quote, a deduction. But whenever you take a deduction for a 401k contribution, you're generally thinking short term. All that is actually a loan you're taking from the government to be paid back at the worst possible time in retirement when your rates could be higher, tax rates in general could be higher, and you're taking a deduction when rates are relatively low. Even the high tax rates are low. We have historically low tax rates. Deductions should be taken when rates are high, and income should be taken when rates are low.
So his point is that during this time of historically low tax rates, he thinks a lot of people have still been pouring money into those traditional retirement accounts rather than things like Roths or doing Roth conversions. So what do you think about his comments here, guys? And is there still time for us to take advantage of these lower rates?
There's absolutely still time. What he's saying and what I agree with is a lot of people are looking in the short term when they are contributing to IRAs, 401ks, things like that. Even when you're working with a tax preparer, most of the time they're looking at this year's taxes and they're giving you advice on putting money into an IRA or raising those contributions to the 401k because it's going to save you money this year. Mm-hmm. But when you look out to retirement and you're getting a plan put together and you're projecting what income could look like, for a lot of people, it doesn't make as much sense when you start looking at it that way because you're putting money into those pre-tax accounts while you're in a lower tax bracket. And then once you retire and you want more income or you have higher income needs, you're going to be in a higher tax bracket and you're going to end up paying more taxes on those dollars. So again, it's about looking at that plan, not just for today, but for the future and finding that balance.
And the fact that we've even had some tax law changes late last year and for the next few years with that One Big Beautiful Bill Act, right? Mm-hmm. So if you're 65 or older, maybe you're still working, you have an additional $12,000 standard deduction. So if your earnings were the same from last year and they're going to be the same this year, you've got an additional $12,000 of income that you're not going to pay tax on. Why put that $12,000 into a tax deferred status when you could just use it, be net even, put it into the Roth? Now you're getting tax-free growth. You're building that bucket for in retirement when something comes up that you can't plan for. Yes, you can plan for your income in retirement. Now, I'm going to need $5,000 a month or whatever that may be for you. But then, well, the furnace goes out. Now I need $10,000 real quick. Well, if the market's not in a good place and now we're selling stock out of your IRA, we're selling at a loss possibly, and then you have to add that on to your taxable income, so that may adjust that income plan, which is going to change the taxability of your Social Security. It could change your Medicare premiums. All that's wrapped up. So having a healthy Roth bucket is one of the most frequent things that is missed. It doesn't have to equal your tax-deferred bucket. I love tax-deferred, and I think what Ed is saying is great, but there could be a balance there too, right? Mm-hmm. If you're a higher income earner and you're in the 32% tax bracket, it's tough to say no to save 32 cents on every dollar I put in there. But find that balance. Really look at your income and how can you diversify this. So the other side of that big tax law change was catch-up contributions going forward. So once you're over 50, the amount of, and I know this personally because I'm going to turn 50 this year. Don't tell anyone, all right? That's just our secret. But now any catch-up contributions you make in your 401k have to go into a Roth. They can't go into that tax deferred. So you're going to be doing some of that already if you're contributing more than $23,000. So you really have to hone in. This is a great time of year to look at what happened last year with your taxes. How much did you put in? What was your discretionary income? How can we adjust your contribution rates, not just to save you money today, but save you more money later on?
And another big part of that I see a lot of people not think about until it's too late is when you're blindly contributing to those pre-tax accounts, you're going to get to the age eventually, 73 or 75 as it is right now, where you're going to start being forced to withdraw a percentage of those dollars and paying taxes on them. And that's where we see a lot of plans blow up because you have lower income needs than what you're forced to take. And all of a sudden now you're being forced to pay that debt, as Ed Slott says, to the government, whether you want to or not. And being forced to just take more taxable income than what you need is not typically a good thing in retirement.
Well, that's why this kind of planning is so important, and I know why you focus on that so heavily at Mattson Financial Services. But for someone out there, they have all their tax documents together anyway right now. It is a good time to come in and revisit their long-term tax strategy. So how can a few of our callers do that with us this weekend?
The best way to get in touch with us is give us a call at 1-800-536-8907. If you've saved $250,000 or more for retirement, we've got people standing by to get you scheduled with one of our advisors to come in and talk about what your current state of the union is, and let's build that plan that's going to get you through retirement. Let's look at the taxes. Let's look at income. What are your taxes today, or what's your income today? What's your income going to be 10 years into retirement, 15 years into retirement? Let's put it all out there. We use a lot of numbers, a lot of charts, but we break it down for you so you can understand exactly what that picture is going to look like as you progress through retirement.
While we're in these historically low tax rates right now, it's an ideal time to sit and talk about your long-term tax strategy for retirement. Again, if you want to take advantage of that special offer this weekend here on Money Mentors, you can reach out in a couple of different ways. 800-536-8907. When you do that today, you're talking to an actual team member right here at Mattson Financial Services in West Michigan. Or you can go online and set up a simple 15-minute phone call, a getting to know you chat at mattsonfinancial.com. That's Mattson with 2 T's, financial.com. Well, the Investment Company Institute finds that 76 million American households today, more than 50%, still own mutual funds. And I know these funds are still popular within those 401ks, guys, but should we look at other options for our savings when we're talking about investing our dollars?
Yeah, so mutual funds aren't a terrible option, but mutual funds aren't the only option when it comes to investing for retirement. A big benefit of mutual funds for somebody who maybe doesn't have a plan together is that you get that active management within the mutual fund. It's being managed for you. It's not just sitting there and not being looked at by anybody. But when we are looking at mutual funds, I always like to bring up target date funds, especially when you're looking at those 401ks. Target date funds basically let you choose a year you think you want to retire, and now they've got a plan for you just based on that year, basically. It's just going to get more conservative the closer you get to that year that you chose in that target date fund. And the problem with that that I'm always talking to my clients about is that they're basically giving the same advice to every single person who's investing into that fund. So it's not what risk is appropriate for you. It's what risk they're deciding is appropriate for every single person invested into that fund. They don't want to get sued. They don't want to get in trouble for being too risky or too conservative. So it's not going to be based on what's best for you. It's just a kind of one-size-fits-all solution, and that's not how a retirement plan can work.
Yeah, those target date funds, all they focus at are the driving factor that motivates the management of that fund is time. Not market conditions, not economic conditions, not geopolitical, nothing. It's time. Time is a factor that we look at, but it's not the only factor. It can't be. You can't just use one source of data to make your investment decisions. Like, that's where you can get into trouble, and you're always kind of chasing that return. The biggest thing I hear from, those target date holders is it doesn't seem to move unless I put money into it.
Yeah.
Probably right. Mm-hmm. So there are other options. Early days in the market, it was all about here are your individual stocks. And that worked well for a while, but it was tough to diversify as the valuations of these companies grew. Think about what a share of NVIDIA costs, right? How many shares can you buy? So that's where you can pick up indexed funds instead of mutual funds. Index funds, you can select specific sectors. You can get as focused in the market as you want, but you're buying a share of that index rather than which proportionally owns all of those different companies. So it gives you the same type of buying power as a mutual fund, same type of diversification, but we're doing it with less fees. They trade like a stock. So if you want to get out of the market at 11 o'clock in the morning, an index fund, you can do that, or an exchange traded fund, you can do that. Mutual fund, you got to wait till the market closes before it sells. Having different options, different vehicles. There's no cookie cutter approach in retirement planning. Your portfolio should not be a cookie cutter portfolio.
So if you're looking for that more customized approach, talk to your money mentors at Mattson Financial Services. They actually help you build the kind of portfolio that's going to help you meet your goals. And yes, if you're still saving and investing in your workplace 401k, that's just fine too. They can actually help you with those decisions as well with the 401k account management program at Mattson Financial Services. So if you're interested in that, talk to our team off the air about it today at 800-536-8907. Get the optimal solution for you based on your individual retirement goals. Get some guidance and some help with those decisions. Again, that's 800-536-8907, or check out more at mattsonfinancial.com. But next, the tax changes impacting your Social Security and how this government program factors into your plans to retire, that age when you retire. We'll talk about it next after the news as Money Mentors continues on Wood Radio.
You're listening to the Money Mentors Podcast.
If you have a question for Gerald, Corey, Gary, Laurel, Taylor, the entire team at Mattson Financial Services, we'd love to hear those questions, and we'd like to address it here on the show and on the podcast too. So feel free to reach out to us at 800-536-8907. You can talk to one of our team members off the air and mention what you'd like to hear on the show, or drop us a line through our website anytime at mattsonfinancial.com. Well, guys, Congress has made some big decisions recently that impact our taxes on Social Security in retirement, but I think there's actually still a lot of confusion about who's impacted, and some might still think that they won't pay taxes on those benefits in retirement. So can you clear this up for us? How does this work, and what do these changes really mean?
Yeah, so our politicians love to say they're going to do things and throw different terms around, but I'm here to say that taxes on Social Security were not gotten rid of. Social Security is just as taxable today as it was last year. But with the one big beautiful bill, what they did do was give the additional deduction for seniors. And how it works is when you're 65 or older, you get $6,000 additional deduction on your taxes if your income falls under certain thresholds, and that is $12,000 if you're married and you fall under certain thresholds. And that was done to potentially help alleviate some of the taxes owed on Social Security benefits for some people, but they did not get rid of taxes on Social Security. It still works the same way it did. The numbers and income amounts are still just about the same as what they were last year. Social Security is still just as taxable as it used to be.
Right. The thing you have to be careful of to get that full standard deduction is you really have to look at what your modified adjusted gross income is, because if you're married and you go over $150,000, like Corey was saying, that those limits, that deduction begins to phase out. So if you've delayed your Social Security, let's say, so you've maximized that, you've got a pension and you're taking retirement funds out and you're upwards of, $170,000, maybe $200,000 worth of income a year, and you have to add on all of the interest you receive at the bank, dividends from your non-qualified account, that all goes into it. So if you get above that 150, you're going to start losing that deduction. So you have to be very careful and very mindful of the income sources that you're taking. Where are they coming from? You can look at Roth distributions to offset some of that. Maybe if you're in the RMD age, maybe you do a qualified charitable donation. So give that RMD to your favorite 501c3 charity, and now that doesn't count as income against you. They get the full amount. You can do different things there to make sure you're maximizing that additional standard deductions. And mind you, it's only here for a few years. It's going to go away as well. Why do politicians do that? They give you something, then take it back. Just let me have it. I'm okay with it.
They want you to remember the benefit while they were there and not let anyone else take the credit for it.
Because they want to get reelected, so they have something to talk about. Hey, you want that to continue? You got to reelect me.
Exactly. This is how this game works in Washington. But for our listeners, I think they don't want to necessarily reduce their income level in retirement in order to avoid some of these taxes and, take advantage of things like this. So I know it actually does take a strategy to keep people kind of in that sweet spot tax-wise in retirement. So for someone who has questions about these changes and how it might impact their planning as they look ahead to retirement, how can they get started with us at Mattson Financial?
Yeah, so if you're curious about it, and you probably just did taxes, so it's a great time to talk about it. For anybody who's saved at least $250,000 for retirement, give us a call at 1-800-536-8907. Get scheduled to sit down with one of our advisors here and talk through these things, come up with a plan not only for the next few years while you can get the deduction, but for the rest of your life to make sure that you're getting any tax benefits you can and the income that you want to have in retirement.
It's a detailed look at your income plan for retirement. That includes all aspects too, including taxes. They put a focus on that at Mattson Financial Services, and you can take advantage of that offer with us this weekend at 800-536-8907. That's 800-536-8907. Or you can always set up with a simple phone call, too, through our website. Just remember our website this weekend. If you're out driving right now, it's mattsonfinancial.com. That's Mattson with 2 T's, financial.com. Well, there's also an interesting new study from AARP that finds nearly 30% of baby boomers today say Social Security eligibility was a major reason they decided to retire. But I'm wondering, from your point of view here, should that really be a reason to retire? And do those decisions have to go hand in hand, retiring and then taking your Social Security?
Well, first of all, I just said I'm turning the big 5-0, and you got to bring up AARP on me.
Yeah, you're getting the mailers too, aren't you, Gerald?
Yeah, right.
Yep.
So, no, that is a common conversation when we're meeting with clients who are maybe in their early 60s and are like, well, I can take Social Security at 62, right? When they're eligible, they're like, well, it's my money, I want it now type thing. So, I listen to that conversation and, I ask further questions. Well, what's compelling that? Is it just you see that dollar sign there, or would you retire and still delay Social Security? You got to dive deeper as a fiduciary advisor and really understand what's driving that decision-making process for them. I always bring the conversation back around to income, though. Social Security is a piece of your income, and it's a guaranteed piece of your income the way it stands now. So we factor that in. If we can maximize those dollars throughout your life, because we're pretty good at what we do, but I can't guarantee that you're always going to make money every year. I think the SEC kind of frowns on that. So it's a matter of building that protected income plan for you using things like Social Security, like maybe a fixed indexed annuity that has an income provision on it, and using some of your investment assets or bank assets to kind of round out what that income plan is.
I literally just sat down with my parents to help them start planning these things, and I showed them. They were dead set on 62. We take Social Security as early as we can because there are benefits. We work for them. They're ours. And I showed them specifically in their plan, if you want the income that you want and you just blindly turn on Social Security at 62, you're getting less benefit. You have to pull more out of your portfolios, and this plan shows you running out of money before the age you want to. But if you just defer Social Security out to 65 or 67, your plan works. So it does make a difference in these plans, and we can show those projections and what the differences are between the different options.
The biggest pitfall I've seen when talking with my clients about Social Security is when it comes to spouses. Maybe there was one major breadwinner in the household. They have the Social Security earnings, and the other spouse is much smaller, maybe a third of what the primary earner in the house was getting. Well, if you both take it at 62, that drastically impacts what that survivor benefit is going to be for the other spouse. So with these spousal benefit options, if you take it early, not only is it impacting your own benefit, but it's going to impact that survivor benefit when the first of you passes away. Everyone thinks, well, I'll get their Social Security. Yes, you will, but you're going to lose yours. So you're already planning for a drop in income. I don't like that. I don't want my clients to plan for less income at any point in their retirement.
Yeah. And if anything, Social Security is a government program, which means it's extremely complicated and they're not going to help you figure it out. So at least make sure you know how it works and what those options are. Because, again, when you call Social Security, they're not going to run projections for you or anything. They're just going to tell you, well, you can sign this form and it can be turned on. That's basically what they're going to tell you.
Yep. And with it being a government program, it's always subject to law changes too.
Yep.
I think what's driving that fear of everyone saying, well, I got to take it now to get my money. I get that. I understand that. But what happens if that benefit is reduced by 25% because of funding? Well, now you're taking an already 30% reduction on your earned benefit, and now you're going to take another 25% off the top of that. Those are real numbers, and that's going to put more stress and more strain on what you're paying yourself in retirement. I want to focus on how can we have other people pay you in retirement, and what you're taking and what you're paying yourself is more strategic and more balanced.
And Corey, I'm glad you shared the story about your parents, because I think a lot of people think that way too. I'm just going to take it at 62, no matter what, right? And I actually had a friend who did this really healthy 6-figure salary. He was making really good money, but he was determined too that, hey, I'm going to get my money while it's there, right? I'm worried about Social Security's future, so I'm going to take it at 62. Well, then he decided to continue working, and then that next tax year, guess what he found out? He was going to lose a lot of it to taxes. I think those are the things we don't think through, but this is why you actually talk to people about this at Mattson Financial Services. It can have really huge implications on their retirement lifestyle and their income along the way, can't it?
Yeah, I had a client recently who had turned on Social Security at 62 and ended up getting a job and got the letter in the mail from Social Security saying, hey, you owe us all of last year's benefits back that we paid you because you got that job and didn't tell us you got it. So you can get into some trouble by not, again, knowing how it works and what the implications are for different scenarios as well.
So be sure to run that Social Security optimization report with your money mentors at Mattson Financial Services. Sometimes it's really enlightening information, even if you think you already have your mind made up. And that is part of our special offer we're making today here on Money Mentors. So if you want to reach out and come in and run those numbers, go through the different scenarios with Gerald, with Corey, the entire team at Mattson Financial Services, you can do that with us. Again, just talk to our team off the air, 800-536-8907, or set up a 15-minute phone call through our website this weekend at mattsonfinancial.com. But coming up, he's helped you around the house for years. Now he's retiring. We'll tell you who that is coming up next. And how do you plan to pay for some major renovations in retirement, if that's on your list? We'll talk about it as Money Mentors continues on Wood Radio.
Getting you not just to, but through retirement. This is the Money Mentors Podcast.
Mr. Clean gets rid of dirt and grime and grease in just a minute.
Mr. Clean will clean your whole house and everything that's in it.
Floors, doors, walls.
Welcome back to Money Mentors. I am Gerald Green here with Corey Davis and Jennifer Perry. Well, guess who's retiring? That's right, Mr. Clean. The bald-headed mascot for Procter & Gamble's brand of the same name has been working for 68 years. So it's probably time. I wonder how much he's got in his 401k.
Right?
Even got pretend people announcing their retirement these days.
Oh, gosh. It's so true. They actually did a whole social media campaign on this. He showed up, guys, in a Hawaiian-looking shirt for his big announcement on Instagram, but in classic Mr. Clean style, he didn't say a word.
It's true. Mr. Clean has announced his retirement. After a career with 0 stains on the record, he's ready for new adventures.
Yeah, so he just stood there at the podium. Kind of cheesy, but kind of fun, too. The company says, though, there will be no change in brand names, but we're going to get more details on what's next for Mr. Clean soon. So we'll see if this stunt works for them here. But no doubt anyone who works, almost 7 decades deserves a break here. But let's talk about the real people that you work with for a second. Do most people want that clean break from their jobs and to go off on new adventures like this guy? Or do they like to more, ease into retirement?
Wow, that just runs the gamut. I mean, I think you've got both ends of the spectrum in there, and I've got clients from one end to the other. Some of the first day I met with them, they're like, I need to retire yesterday. And then there's I have other clients that are like, I don't know. I like my job. I'm never going to, why retire? I don't need to. I enjoy what I'm doing. Still making money. They're still paying me. They like what I do for them. So why retire? So yeah, it's running that full gamut of emotions. I think what drives people to have that visceral kind of reaction to retirement is whether they have a plan or whether they don't, right? And some do, some don't, but putting it and making it tangible really helps them. And then some clients come in and say, I don't know, I kind of want to retire, but I'm okay if I don't. I just want to make sure that when I do retire, I don't have to go back to work if I don't want to. If I choose to, great. But I want to know that my family's safe, I'm comfortable, I can contain or maintain the lifestyle I have right now.
Yeah, and I had a client recently who retired, was 100% sure he wanted to retire, did not want to go back to work, and then found out that if he took the part-time job at the golf course, they'd let him golf for free. So all of a sudden he had a job again in retirement. So your plan's got to allow the flexibility of different things happening. Again, it can't be this, you're retiring, you cannot work again, you have no options is what you have to do. It's got to be flexible and allow you to stop taking income, turn income back on, whatever that looks like to make sure you can enjoy your retirement, not be stuck in a one-option plan that you put together at the beginning.
You can only do this.
Yes.
No. We got another client, I think he retired about 37 times, and I love Ken. He worked, and then he was so good at his job and what he did that, other people knew about it. So they're like, all right, come work for us. And if people are going to throw gobs of money at you for doing something that's very easy to you, it's tough to turn that down. It's okay, but you have to have that plan in place that says, okay, I'm going to retire, but then what happens if you go back to work? How do things have to change, like Corey was alluding to? How do you shut off other income sources or make sure that you're not paying more in taxes just to continue to do that? What's it going to do to your Medicare? Did you file Social Security already? All of those answers, yes, there's some latitude in what you can change and adjust with a lot of things, but the sooner you know that, the easier it is to make those adjustments. And you can ease into retirement or you can hit it straight on as long as you have a good plan that takes into account all of those options, right? Like Corey said, we don't want one choice in retirement. What we want to do is be able to do this, but what if we call that audible 3 years down the road and say, you know what, now I'm going to go do this. Great, let's figure that out.
And maybe it's not a choice. We had clients who retired and won a significant amount of money off of a scratch-off ticket. So some things are going to happen, can happen. I'm not saying you're going to win the lottery, but things can happen that aren't a choice, too, and your plan needs to be able to change and be flexible for those things as well.
That sounds like a nice surprise to be able to walk away with that scratch-off ticket, or, hey, the job at the golf course, too. I love that, too. So, again, keeping your options open is important, and having a plan gives you some of those options. We'll tell you more in just moments here about how you can get started on that plan with your money mentors to find out what that looks like for you. But let's say you've decided to stay put in retirement, but you want to fix up the home. A 2026 survey by home improvement site House says the median price for a kitchen remodel this year comes in at $55,000 for a major reno, about $20,000 for more minor kitchen projects. And either way, that's a big chunk of change, especially if you are retired and looking at your income. So how do you help people put those kinds of renovation costs, when we're talking about big numbers like this, into that retirement budget? Because this is a priority for a lot of people.
I was just meeting this past week with some clients, Mike and Helena, that were talking about doing an addition onto their pole barn. Like they needed it, they're going to do it. They kind of have the cost, and the conversation was around it started around what their income was at that point, and like, okay, how are we going to pay for this? We've got this income plan set up. You've got some of these other investments out there. How do we make sure that, this can get paid for without hurting you long term? And Mike and Helena, they do a great job budgeting. He's one of those retirees. He retired, but he's farming. They do the farmer market stuff, and it generates money for them. So they're still doing it. And I'm like, Mike, when are you gonna stop? Oh, I don't know. And we still got the stand out front. He said, like, they just enjoy doing it. But what we looked at and ultimately came to is he's just going to kind of cash flow that out of his savings. He thinks he doesn't believe he'll have to take more money out of his retirement accounts. But we explored all options. He had some other previous investments from other advisors that weren't performing so well. So we've got a plan to move those and try to make those work better, just in case something happens while he's cash flowing this. And then, all right, what if, God forbid, the furnace goes out or something? Now we need extra money that his cash flow is not going to be able to adapt to that. We have another bucket we can pull funds from to make sure that we can take care of him for those projects.
It's all about having those conversations when you're coming up with that plan. So, yeah, I'm always going to ask when I'm sitting down with someone if they have house renovations and things coming up, but you don't always know. And also, it's about thinking ahead to retirement. If your plan's to stay in your home your whole life, are you always going to be able to walk up to the second story to go to bed every night? Are you going to need to install the bars and the shower to hold on to and that kind of stuff? Or do you want to move to maybe a 55 and older community or something like that when you get older? So it's about thinking about those things ahead of time and kind of knowing what that path looks like for you so you can plan for them.
Yeah, that was funny because that was the next conversation we had about the house. Him and Elena are in an old farmhouse, and she wants to stay there, and he's like, I'm okay. I can stay there. I can move. It was. I joked with him. I'm like, I hope I didn't cause an argument for the car ride home. But there was some. There's some renovations that have to go in the house because the question I typically ask is it conducive for aging in place?
Yeah.
And the short answer was probably not. I joked with Mike that he's no longer a spring chicken. Like, we got to think about these things now while you're still young and spry, Mike, so that way they're not that big of an issue later on.
I don't know about you, Gerald, but this 50 milestone has me thinking about things like shower bars a little bit more.
I'm not there yet. I will fight tooth and nail before I get there.
You've only got 5 years till you can think about those 55 and up communities and things like that.
Thanks, Corey, the young one on the show this
Corey
week.
and I are going to have a private conversation after the
words after the show. But again, when it comes to things like renovations around the house, deciding where you want to live, again, maybe it's uprooting and moving to a smaller place or something that's more accessible for you a little bit later in life, and deciding too on, when you want to retire. These are all things that we want to be options for you, things you're not stressing about, but you do have to build those into your plan. So, guys, why don't we invite a few of our listeners this weekend to come in, share those dreams, those goals, those desires with us, and get started on that plan.
Yeah, start thinking about your want list. What do you want to do in retirement? Chances are you already know what you have to do. You know what utilities are. You know what property taxes are, insurance. That's not the fun stuff to talk about. I want to talk to you about what do you want to do. What are those big dreams, goals, and desires? And really, let's get down to brass tacks and building that plan for you. So if you've saved at least $250,000 or more for retirement, give us a call at 1-800-536-8907. Sit down with Corey, sit down with myself, Gary, Taylor, Marcus, David. We've got a whole host of fiduciary advisors here. They're going to have these conversations with you, take a look at every aspect. So when we present that plan to you, you see completely everything that we've looked at. There's no real gray area about, okay, well, what if this happens? Or what if this happens? Like, we've talked about it. We've set an initial plan for it, knowing that we can adapt. So again, 1-800-536-8907. I know the girls from the front desk are standing by to take that phone call from you, and they'd love to get you scheduled.
Yeah. In fact, they'll be doing that for a few minutes after today's show, so still time to get in on this offer today. Talk to your money mentors at Mattson Financial Services about those things you want out of your retirement. Again, that number is 800-536-8907. You can pick up the phone at any point right now, or Monday through Friday, too, at that same number, 800-536-8907. Or simply go online. You can also schedule a 15-minute phone call by accessing our calendar there. Just hit that Schedule Now button. Again, that's Mattson with 2 T's, financial.com. And be sure to join us here again next weekend for more lessons right here with your money mentors.
Remember, retirement is not a destination, rather a never-ending opportunity to exceed your dreams, your goals, and your desires.
Have a great weekend, everyone.
Want weekly lessons from your money mentors? Yes. Hit the subscribe button now and listen every weekend on Wood Radio.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Fee-based financial planning and investment services are offered by Mattson Financial Services, LLC, an SEC-registered investment advisor. Insurance products and services offered through Lakeview Financial Group, LLC, Mattson Financial Services, LLC, and Lakeview Financial Group are affiliated. To find out if Mattson Financial Services is licensed in your state, please call 800-536-8907.